Bitcoin has no CEO, no headquarters, no government department, and no customer service desk that can reverse a payment or freeze the entire network. So who is actually in charge? Is it the miners, with warehouses full of specialized machines? Is it the nodes, quietly checking every block? Is it the whales and institutions holding enormous amounts of Bitcoin? Or is it ordinary users, people who may never have written a line of code or mined a single block? Here is the real test. Imagine all four groups disagree tomorrow. Miners want one set of rules. Node operators want another. Large holders threaten to sell, and users refuse to follow. Who wins? The answer reveals what makes Bitcoin fundamentally different from a company, a bank, or even most other digital networks. The simplest answer is that nobody controls Bitcoin. But that answer is incomplete. Power still exists inside Bitcoin. It is simply divided into different roles, and each role comes with a boundary. Miners produce blocks and provide proof-of-work security power. Full nodes check whether those blocks obey the rules. Holders bring economic weight, liquidity, and confidence. Users decide which software, services, and ultimately which asset they are willing to accept. These roles overlap. A miner can also run a node. A developer can also be a holder. A business can be a user, a custodian, and a node operator at the same time. But no role automatically receives every kind of power. That separation is the point.
Let us begin with the group that looks the most powerful, the miners. Miners collect valid transactions, choose which ones to include, arrange them into candidate blocks, and compete to find a proof-of-work solution. The winner broadcasts a new block to the network and receives the block subsidy and transaction fees if that block is accepted. This work matters. Mining orders confirmed transactions into a public history. It makes rewriting that history increasingly expensive, and the enormous competition between miners helps protect the chain against attack. Miners also have real discretion. They can prioritize transactions that pay higher fees. They can leave transactions out of a block. They can signal support for certain upgrades, and large mining pools can attract attention whenever their share of the network grows. With a majority of hash power, an attacker could censor transactions or attempt to reorganize recent history. That sounds like control. But there is a hard limit. A miner can create a block. It cannot force independent full nodes to accept that block. If the block creates too many coins, spends Bitcoin without a valid signature, or breaks another consensus rule, validating nodes reject it. It does not matter how expensive the mining equipment was. It does not matter how much electricity was used. Invalid work is still invalid. Think of miners as highly competitive publishers. They can propose the next page in Bitcoin's public history, but every full node checks that page against its own copy of the rulebook. Miners are powerful, but they are not kings.
Now consider the full nodes. A full node independently verifies the blocks and transactions it receives according to the rules in the software it runs. It does not need to trust a miner's promise. It checks. Are the signatures valid? Were the coins available to spend? Does the block satisfy proof of work? Does it respect Bitcoin's supply and other consensus limits? If the answer is no, the node rejects the block. This creates one of Bitcoin's most important power boundaries. Miners decide which candidate block to publish, but full nodes decide what they themselves will recognize as valid Bitcoin. Still, saying nodes control Bitcoin creates another misunderstanding. Nodes are not shareholders in a company. Bitcoin does not hold a formal election where every node receives one vote. If someone launches 10,000 nodes that nobody relies on, that does not automatically give that person 10,000 times more authority. Each node enforces the rules for itself. Its wider economic influence depends on who relies on it, and what economic activity depends on the rules it enforces. A node is not a ballot paper. It is an independent verifier, and that distinction matters.
What about the whales? A person, company, fund, or government holding a large amount of Bitcoin can have enormous market influence. A major sale can move the price. A major purchase can change sentiment. Institutional custody can affect liquidity. And public announcements from large holders can influence millions of smaller investors. This is real power. But it is economic power, not automatic control over the protocol. A wallet containing 100,000 Bitcoin does not receive 100,000 votes on the consensus rules. Bitcoin is not a shareholder meeting. And Bitcoin's base layer is not proof of stake, where control of the asset directly determines who validates the next block. A whale cannot sign a message and create 22 million Bitcoin. An exchange cannot vote to remove proof of work. A fund cannot edit the supply cap simply because it owns more coins than you do. Large holders can influence what the market values. They cannot, by ownership alone, make an invalid block valid. Then we arrive at the broadest and most difficult group to define: the users. Users are not only individuals holding Bitcoin in a wallet. They include merchants accepting payments, exchanges deciding which chain receives the BTC ticker, wallet providers choosing which network their software supports, custodians processing deposits, companies building services, investors allocating capital, and people running their own nodes. None of these participants has a magic control panel. But together, their choices create Bitcoin's economic reality. Which software will they run? Which deposits will an exchange recognize? Which asset will a merchant accept? Which chain will investors value? Which network will businesses continue to build on? These decisions cannot make a block pass rules that a validating node enforces. But they can determine whether a technically functioning chain has users, liquidity, infrastructure, and market value.
This is why Bitcoin governance is not a simple vote. There is no official ballot, no single election day, and no perfect method for measuring what every user wants. Instead, preferences appear through action. People install software, businesses announce policies, miners direct computing power, exchanges choose tickers, holders buy, sell, or wait, node operators enforce rules. The process can be slow and frustrating. That friction is not always a failure. When changing the rules requires coordination across many independent groups, controversial changes become difficult to force through. Bitcoin's resistance to control comes partly from its resistance to easy change. There is one more group we need to mention: the developers. Bitcoin developers write code, review proposals, test software, find bugs, and publish releases. Their expertise gives them influence because most users will never personally inspect every line of consensus code. But influence is not the same as command. Bitcoin's software is open source. Developers can propose a change and publish code. Others can review the proposal, decline to merge it, modify the code, or publish alternatives. Most importantly, nobody can force miners, businesses, node operators, or users to install a new version. Developers can build a door. They cannot force the network to walk through it. Now, return to our original question. What happens if these groups disagree? Imagine developers publish software with a controversial new rule. Some miners support it, and if they adopt the new rules, produce blocks consistent with them. Some node operators install the new software, while others keep enforcing the old rules. Large holders take positions on both sides. Exchanges, wallets, merchants, and users must decide what they recognize. There are several possible outcomes. If support becomes broad enough, the network may coordinate around the change. If support remains weak, the proposal may be delayed, revised, or abandoned. And if incompatible groups refuse to compromise, participants may split across two chains. At that moment, no press release can guarantee which chain the world will call Bitcoin.
One side may have more miners. Another may have more economic support. One may preserve the older rules. Another may claim a better future. Which chain retains the Bitcoin identity depends on the rules its participants enforce, where proof of work goes, what infrastructure supports, where liquidity forms, and what people voluntarily use and value. This is messy, but it is very different from a CEO issuing an order and the entire system obeying by Monday morning. So, who really controls Bitcoin? Not the miners alone. They produce blocks and secure the chain, but nodes can reject invalid blocks. Not the nodes alone. They enforce rules independently, but they cannot force the rest of the economy to value their preferred network. Not the largest holders. They can move markets, but their coins do not give them extra protocol votes. Not ordinary users acting individually, but collectively, users and businesses decide which version of Bitcoin has economic life, and not the developers.
They create software choices, but adoption remains voluntary. The most accurate answer is this: no single group controls Bitcoin. Its shared history is secured by proof of work. Its rules are independently enforced by nodes. And its economic reality is created by people and institutions voluntarily choosing which network to use and value. Power is distributed. Every group can influence the outcome. Every group also faces a limit. That balance, not the absence of power, is what makes Bitcoin decentralized. In the next episodes, we will go deeper. Why do miners keep operating when the economics look brutal? Who actually owns most of the world's Bitcoin? And why, in a dispute over the rules, might a quiet full node matter more than an entire warehouse of mining machines? This is BTC Window.